So today we are going to start chapter 3, and chapter 3 is job order costing for cost of flows and external reporting. And this is a very, very important chapter. Okay, so listen carefully. Okay, before start, we have to review some key terms. The first one is job order costing. So what is the job order costing? Can you tell me? Jindan, can you use your own word to summarize? What is the job order costing? I already highlight the important parts. Yeah, so today we are going to start chapter 3. Yeah, and this is a very important chapter. Okay, so before starting this chapter, we are going to review some key terms. So now I'm asking Jindan, ask him to let us know what is the job order costing. Okay, so Jindan, what is your answer?
The costing system that used when many different products or jobs produce the same period.
Okay, so that is a costing system and used in situations where many different products or services are performing at the same time, and they are unique, right? They are different from the other services or products. Okay, so in that situation, we use job order costing. Okay, and then the next one is absorption costing. So what is it? Gato. So what is it? Yeah, there's a hint over there. Okay.
I read that it's a cost that includes a costing method that includes all the manufacturing costs. And the other manufacturing costs are direct labor, direct materials, and manufacturing raw material.
So absorption costing includes all the costs that you just mentioned in the product cost.
Yeah.
Is that correct?
Yeah.
Yes, including variable and fixed.
Yeah.
Right? Manufacturing and non-manufacturing,
Yeah.
right? Yes. Okay, good. Okay, so the next one is allocation base. So what is an allocation base? So Peggy, what is an allocation base? You can read. Yeah. Yeah. So it is the measure of Very good. Okay, so that is the base used to assign the cost to cost of objectives. Oh, so what is the cost of objective? What is the cost of objective? What?
Cost objective.
Yes.
It was
Product? Any product? Yes. A cost objective, it can be any product or any service.
Yeah.
Yes, cost objective can be a service, can be a product.
Yeah, everything is connected to a cost.
Yes, good. Yeah, okay. And the next one is predetermined overhead rate. So what is it? That is the rate used to charge manufacturing overhead costs to jobs.
Yeah.
Okay, good. And then overhead application. So that is a way to apply the predetermined rate to assign the manufacturing cost to the cost of objectives. Okay, and next one is normal costing. So what is a normal costing? The key word is the actual. Yeah. So that is the system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base incurred by the job. Okay, so remember, use the actual usage. And the last one is job cost sheet. That is a form to record the direct materials, the direct labor, and the manufacturing overhead cost charges to a job. Okay, so come to our learning objective 1 and 2. For learning objective 1, you have to understand the flow of costs. and you have to prepare journal entries. Okay, for objective 1, you have to do these 2 things. Okay, understand the flow of cost and prepare the journal entries. And for the new objective 2, you have to know how to do T accounts. How to do T accounts to show the flow of costs. Okay, so 3 things to do. Okay, and before doing that, you have to know RM, WIP, FG, and the COGM, the 4 terms. Okay, so I think just read the last one, cost of goods manufactured, COGM. Okay, that include the manufacturing costs associated with the goods that were finished during the period. Okay, the key word here is the finished. Okay, finished goods. Okay. Okay, so this is a chart for the flow of costs. Okay. Okay, have you seen the balance sheet? Here, balance sheet. Here. Okay, and here is the income statement. Okay, they are the 2 financial statements of a company. Okay, 2 major financial statements of a company. Okay, and you have to know what accounts are included in balance sheet and income statement. Do you still remember? I think Gado, you don't have the. Have you been taking accounting course? No. Okay, but Gado, yes, right? Yes, yes. You are the second. Gado, Jinda, you are in the 2nd year, right? So you took that last year. Yes, financial accounting and Peggy too. Okay, so what accounts are included in balance sheet? The 3 major terms are, the first one is what? Assets, right? For balance sheet, we start from assets, right? Assets equals what?
What did you say?
I will use that blackboard.
Equals liability increase.
Liability plus overhead.
You ask for data?
Assets, yes. Owner, liability plus owner asset. And just over there. So balance sheet. Include assets. What and then? Assets.
Equals liability plus owner equity.
Owner's equity, right? Or shareholders' equity. Okay. And for income statement. I think that's right. For income statement. We have expenses, right?
Yeah.
And what?
Revenue.
Yeah. Okay. And then this is the T account, right? T account. T account. And T account here. T account here. Okay. So when there is an increase in assets, which side do you put? So we call this is left side, this is the right side, and left side we call it debit, and this one, right hand side we call it credit. That is the right. Okay, so when there is an increase in assets, like you buy a land, so your asset increase, right?
Yes.
So where did you put, which side?
On the left.
On the left, right? So here, right? And when you sell the land, what happens?
The opposite.
Reduce, right? Reduce your asset. So up this side. Okay. If you increase your liability, like if you borrow money from the bank, which side increase?
Debit.
Debit or credit?
Credit.
Debit or credit? This two is update. Here is inside update. So in this side, increase here.
Yeah.
So in this side, increase here. The update.
Cioè, if you borrow money from a bank,
Yeah.
your credit is
You
more.
debit.
Yeah.
Yeah. Please
Because you
don't
have
think about the meaning of that,
Debit,
right? Just left and right.
Okay.
Only left and right. That is the only meaning.
Yeah.
Okay, left and right. Okay, so when the company increase their liabilities, right side increase. Okay, so reduce, you pay off the debt, then reduce the credit debit. Okay, and here the same. Here the same. Okay, because they two are the same side, so the same. Okay. Okay, and this is income statement. Okay, income statement only record expenses and revenue, right? So when expenses increase, your owner's equity reduced, right?
Yeah.
So same side. So expenses when increase, right? I'm confused. Yeah. Other side, right? So this is like this, and the same, right? Yes. Why? Because the revenue will increase owner's equity. So revenue occurs at the same side as owner's equity, but expenses will reduce your owner's equity, so up this side. Okay, so here, okay? Yeah, okay. For product cost, we have raw material, right? We have raw material, we have direct labor, and we have manufacturing overhead. This is our product cost. Okay, and then we also have period costs that include selling and administrative. Up to here, okay? Yes, I believe. Okay, okay. Here is the cost for product and for period cost, and then here is the balance sheet. Balance sheet. When the production starts, okay, you will incur the raw material cost, right? So you put raw material to here. And you also have put direct labor here and manufacturing overhead here, okay? And for here, we have raw material. Under balance sheet, we have raw materials inventory. So inventory is an account of balance sheet, okay? Inventory. And the inventory include raw material inventory, working in process inventory. Okay, and then we have finished goods inventory. So 3 forms, okay? There are 3 forms for inventory. Raw material, work in process, and finished good. Okay, and both work in process and the finished goods include direct labor and manufacturing overhead. Okay, so they are all balance sheet account. Okay, balance sheet account. Okay, and when the finished goods are sold. When the finished goods are sold here, when the goods are sold, we incur cost of goods sold. Cost of goods sold, and it is an income statement account. Yes, okay. And we also incur period costs like selling and administrative expenses, and they are here. Selling and administrative expenses, they are under income statement. Okay, so you have to memorize which account belongs to which. Okay, like expenses and the revenues are accounts of income statements. Assets, like inventory, are included in balance sheet accounts. Okay, yeah. Okay, yeah. Okay, next. Okay, now let's do a job. Okay, like now, can you read? Can you read? Before I explain. Yeah.
The income statement is made by cost of goods sold and
Cost of goods sold is an account of income statement. Yeah.
and selling and
Yeah, they are all income statement accounts. Okay, and to illustrate the cost flow within a job of the costing system, we will record the larger corporations transactions for the month of April. Okay, and this company is a producer of gold and silver commemorative medallions, and it worked on only 2 jobs in April. Okay, so this company only are working on 2 jobs in April. Okay, and job A. Okay, job A is a special meaning of 1,000 gold medallions. It's hard to read. Commemorating the invention of motion pictures, and the job was started during March. Okay, the job A was started during March and completed in April. So in April, it's completed. And it was assigned 30,000 in manufacturing costs, which corresponds with Roger's working process balance on April 1 of 30,000. So that is a work in process balance. Okay, and job B. Okay, job B is an order for 10,000 silver medallions commemorating the fall of the Berlin Wall. This one is started in April and was incomplete at the end of the month. So job B is not completed. So you have to remember the information. Okay, so only 2 jobs. Job A and B. A is completed in April, but B is not. So it's still in working process. Okay. Okay, here. This is a cost of flow. Okay. T account. Okay. So we have a raw materials account. We have a raw materials T account. When you purchase the material, you debit your raw material because the raw material is part of the asset, right? Do you remember? Raw material is part of the inventory, and the inventory is an account of the balance sheet, right? And for balance sheet, if you increase your asset, you debit that account. Okay, so we purchase raw materials. So that means our raw materials increase. So we credit our raw material. That is left-hand side. See, so it's left-hand side. So material purchase, you put here. Okay. Okay, and when you put the raw materials into production, that raw material will go to work in process, right? See, will go to, can you see the circle, the cursor? Okay, so the direct material will put into work in process. So your raw material account will reduce. So you credit your raw material, and then you will increase your work in process. So you debit your work in process. Oh, remember, when there is an increase, you will see the other reduce. If they are on the same side. Because that is the equation should always remain equal. Asset equals liability plus owner's equity.
But why direct materials in working process?
I'm sorry?
Why direct materials in working process are embedded on the...
Because see, you understand this side, right?
Yeah.
Okay. Now you put your raw material into production, right? So the raw materials will go to working process. See, so here you reduce the raw material, but here you increase your working process. They equal, no change, because they are both on asset side.
And why?
Why reduce, why increase?
Because they're on opposite side.
No, they are on the same side. Because material is part of inventory,
Yeah.
and the inventory is part of asset. So they are all on asset side,
Yeah.
right? So material reduce, work in process increase, so they will offset. They are all assets, but different account.
Yeah.
Understand?
No,
Title.
not so much.
Yeah, this is the most hard, the hardest part of accounting. Yes. So always remember the equation, because sometimes I will get confused, but I will put down the equation. See? Raw material is under asset, right? And work in process is also under asset, right? So now I will put raw material into production. So I will reduce my raw material, right? Because I will move the raw material to the factory and put it into production.
Yeah.
Okay,
This is
so
here.
Yes, and then when we start to process, it's not finished. So everything you put into will accumulate in WIP. Raw material reduce here, and your working process increase here. The same amount, like if I put 10,000 into production, it's 10,000. Yeah, so they will offset. See, one minus, one plus, they will offset. The asset remain unchanged. The equation is still the same. Understand?
Yeah, I don't understand. I understand that it's on the same, so.
Same side, yeah.
But why the increase on debit? Because if I put my raw materials in work in progress.
Because they are different accounts. You have to know how much are left in your raw material. So that you will know when you have to order more raw material. So you have to keep it separately. Okay? So that's what it means.
Yes.
Okay? And same thing, we have indirect materials, right? We have indirect, remember, we have an indirect material and direct material, right? And indirect material also part of the raw materials. But when you start to produce, you have to use some of indirect materials, but they will accumulate in the manufacturing overhead. So you reduce your indirect materials, but you increase your direct materials used in manufacturing overhead, because they are also on the same side. So offset. No, here. Okay, think. You have to think. You have to understand. Otherwise, no use. Okay. Ryan? Okay? Yes. And then Elman? Yes. Okay. And are you taking the notes? You use your. Okay. I think down here this is more important. Yeah. And make sure you understand, because I will put this I think I already put this on our class. Yes. Okay. Okay, Chicago, okay? This one, okay? You put your indirect material because during the production you have to use some indirect materials. Okay, so your indirect materials will be reduced, but where will be increased? Your manufacturing overhead, because you accumulate all the indirect cost to manufacturing overhead. Right? Yes, okay. So this is called cost flow. Okay, here, this is called journal entry. This is the journal entry, okay? And in January, on April 1st, this company had 7,000 in raw materials on hand, and during the month, the company purchased an additional 60,000 in raw materials. So your raw materials will be increased by 60,000, right? You debit your raw material by 60,000. Where is the other account? Because the question tells you that this is purchased on account. That means you haven't paid it yet. So you incurred account payable. And account payable is a liability account. Okay, account payable is a liability account. So your raw material increased by 60,000, and your accounts payable also increased by 60,000. And see, here you increase, right? Because raw material is an asset account, and the other side, your liability also increased. So the equation is still equal. And this is called a journal entry. And this is the basic financial accounting content. Yeah. I think Gato is very intelligent. He can understand. Yeah, I think you can. Yeah, I think you can understand. You don't have to know how to record, but you understand the concept.
Yeah,
yes.
Yeah.
Okay.
No, but if I think in only mathematical way, I can do it because it's an equation, so one on the side.
Yeah.
But on the logic side, I
don't. You have to treat yourself like a machine.
Okay.
Only left and right. Okay. Don't think too much.
Okay.
Don't think too much. Don't think about the credit or debit.
Yeah.
It will confuse you.
Yeah.
Yeah. You will confuse. Just remember, debit is debt, credit is right. Only left and right. Only the two sides. No other meanings. Okay. And that is called a journal entry. So every day, when every transaction occurs, we have to record. Okay. Then also what? Okay. Also during the same month, April, materials requisition firms were prepared to authorize withdrawing 52,000 in raw materials from the storeroom for use in production. So 52,000 of raw materials are put into production. Okay, that is what that means. Okay, and these raw materials included 50,000 of direct and 2,000 of indirect materials. Okay, 50,000 direct, 2,000 indirect. Okay, and that is the journal entry for this transaction. Okay, so our work in process increased by 50,000 because that is a direct material. You put direct material into work in process. Okay, and then you increase your manufacturing overhead for the indirect material. That's 2,000, and then your raw materials will be reduced by 50 plus 2,000 raw material and indirect material, direct material and indirect material, and in total there's 52,000 of raw material. So that is the journal entry for this transaction. Okay. Understand? Yeah. Okay, don't feel sleepy, okay? Because it's really, this chapter is really important, very, very important, okay?
And why it goes on the right, on the...
Wait. Okay.
We have the 50 is made by the raw materials.
50 is raw material, direct. 50 is direct material, and 2 is indirect.
Yeah, and we put on the left, and then at the point on the right.
Right, because it reduces. Let's go back to the T accounts. Yeah. When you put your direct materials into production, your working process increase. And when you put in direct material into production, your manufacturing overhead becomes increased. So they are different. So you have to accumulate them into the correct account. Jun, okay?
Okay.
Okay.
Not my work in process increase. My left side of work in progress increase.
When you put the direct material into production, your left hand side of work in process increase. Yeah, that's correct. I always have to think. I have to use my hands to help me figure out which is right. No, this is that, and this is right. Because I always say this is that. So every time when I said when my husband is driving, when I say turn left, I always say turn this is left, turn left. I will do this.
Yeah.
So he has to see my hand, not listen to me, because I always say turn left, turn left. This is right? Yeah, I always say turn left. So I always confused. So I have to use my head to help me to figure out. So this is right, this is left. And so every time when I'm doing T account, I have to write down that formula to help me to figure out which side is which. You can do this, yeah. Because I think my space is not good. It's hard for me, yeah. Okay, you okay? So when you put direct material into production, you increase your what?
Left side work in progress.
Yes. Okay. And when you put your indirect material into production, what increase?
Left side of MOH.
Yes, that's correct. Here, yeah. And in the direct labor, the same logic. So when you put the direct labor into production, then your working process, the left-hand side of your working process increased. And when you put indirect labor into production, then your manufacturing overhead increased. Okay, same thing, okay? Yeah. Okay, here. So in April, the employee time tickets included 60,000 recorded for direct labor. So 60 direct labor and 15 indirect labor. Okay, 60,000 of direct labor and 15,000 of indirect labor were put into production. Okay, so this is the journal entry. So your working process will be increased by the direct labor. That is 60,000, right? And your manufacturing overhead will be increased by 15,000, which is indirect labor. But you incur the salaries and the wages payable. That is liability. Okay, you have to pay them, right? You have to pay your labor. Okay, so you incur the salaries and the wages payable, and which is a liability account. When liability account increase, you credit. That's right hand side, right? Yeah. Okay. Yeah. Okay. 75,000. Okay. Okay. Here. And other overhead. Okay. Yeah. Okay. Yeah. You incur other overhead. Okay. Okay. Next. Okay, then assume that Roger Corporation incurred the following general factory costs during April, like utilities, 21,000, Okay, and rent on factory equipment 60,000, and the miscellaneous factory overhead cost 3,000. They are all other overhead, right? Okay, so you also incur manufacturing overhead 40,000. That's 21 plus 16 plus 3. So that's 40,000 of manufacturing overhead increased by 40,000, and you have other accounts payable. That is also 40,000. So one asset, the other one liability, same amount, okay, still equal. Okay. Or sometimes you pay by cash. Okay, so you will reduce your cash if you pay by cash. Okay, so you can also record like a manufacturing overhead increased by 40,000, and your accounts payable like 30,000, and cash 10,000. Okay, if you put cash on right hand side, that means your cash is reduced. Okay, when cash are on the left hand side, your cash increase. When cash is on the right hand side, your cash reduced. Understand? Yeah. Okay. You are all better than me. When I first took accounting class, I'm always confusing about why sometimes cash is there and why sometimes cash is on the right hand side. I'm totally confused. Yeah. Yeah. Yes. Are you confusing now? No. Okay. Okay, and let's go to. I think this is hard. This is quite hard. Okay. See, we incur actual overhead cost, right? But do you remember we have a predetermined overhead rate? So we set the rate before the production. So when the production starts, we apply the predetermined rate, right? So they are not the actual cost. They are the cost you applied. Okay, so see, this is the actual under manufacturing overhead. There is an actual when the actual manufacturing overhead increase, you put on the left hand side, but for the applied one, you put on the right hand side. And when you apply the overhead, that overhead applied will go to your working process. To understand this concept. Okay, so when you apply your overhead rate, you increase your working process. That means you include the cost to your products. And for the applied overhead, you reduce your manufacturing overhead. And when the actual and applied manufacturing overhead are not equal, a year-end adjustment is required. So at the end of the year, we have to compare the actual manufacturing overhead to the applied manufacturing overhead. If they are not the same, you have to do a journal entry to adjust the two accounts. Okay.